How big of an impact do US presidents actually have on the stock market? Now, the stock market is a topic that gets brought up a lot during a presidency. It's one of the main scorecards that people use to judge how a presidency is going. In this video, we're going to explore whether that is appropriate and how much control do presidents actually have over the S&P 500. So right now we live in an era where I would not blame you if your reaction to that question was, well, obviously, presidents have a huge impact over the direction of the stock market. As of right now, the market is moving on 6 a.m. Truth Social posts, tariff announcements and pauses and announcements and pauses, the 15 editions of Iran peace plans that get put on and taken off. So the market jumps a lot based on announcements from President Trump and then announcements removing those announcements. So anyone who's looking at the stock market over the last 2 years, I would not blame you for thinking the man in the Oval Office has a huge impact on your portfolio. I mean, just look at the chart on this slide. It is of Liberation Day and the days that followed. One single policy announcement over the course of 2 days sent markets tumbling. The S&P 500 fell 11%. The Mag 7 was down 12%. And it wasn't just US focused. Markets in Europe, China, Canada, and Mexico all turned lower. So clearly, if you're looking at this, presidents obviously impact stock markets. Not so fast. So I've had a lot of fun posting this graphic and similar graphics on LinkedIn and Twitter over the last week or so. I've got a lot of interesting comments and DMs about it, mainly from people who don't actually read what I write alongside the graphic. And disclosure, I wrote about this exact topic in long form in my BuyPartisan newsletter on LinkedIn. I did have a few requests to turn it into one of these Macro Monday videos, so that's what I'm doing. I generally try not to reuse content across different channels, but it is the end of August, it's the end of summer, and this is a really interesting topic, and I think it fits in both of our Macro Monday as well as our long form newsletter BuyPartisan. So if you haven't read that and you want to read a long form with more well thought out arguments and theses, I'll have a link to that in the description of this video. But here's the ranking. And the one thing I want you to notice is look at the top three and look at the bottom three. Now, this might go against what is a commonly held belief that people have, which is that Republicans are great for the stock market, Democrats are bad for the stock market. This sort of flips that on its head. You have the top three, Bill Clinton, President Barack Obama, and FDR. Then you have the bottom three, Nixon, George W. Bush, and Herbert Hoover. So what's at play here? What is the dynamic that is creating this? Well, simply put, maybe presidents have a little bit less control over the stock market than we actually think. Now, before I continue, I do want to say this ranking is not a ranking of who I personally think was a good president or any sort of objective measure of who was a good or bad president. That is not the goal here. Again, so the DMs that I have been receiving think for some reason that this is my personal ranking. This is not that. This is just a ranking of the presidents in order of the S&P 500's price return during their tenure. Now, the question of whether or not these men led the country well is a different conversation, a more important conversation, but that is not the conversation that we are having right now. So let's start at the top with Bill Clinton. So Bill Clinton, a market darling. The S&P 500 over tripled when he was in office. So he must have had these pro-growth policies that sent stocks soaring. Well, no. The thing Bill Clinton is most known for, should say second most thing he's most known for. We'll get to the first thing later in this video when we talk about presidential scandals. But the thing he is second most known for, in my opinion, is he's the last president to preside over a budget surplus. And he was the first since 1970, and there's been no president since. The deficit has just continued to rise since then, but Bill Clinton increased taxes and aggressively cut spending, and that led to the surplus that you see here in the chart, where the line dips below, or I should say above, zero. So, if you run his framework through any sort of economic or stock market theory or framework, whatever you want to call it, this would be bad for equities. At least we would assume, right? Higher taxes on corporations, on wealthy individuals. The theory goes that's going to draw money or put pressure on equity markets. Well, how does that line up with Bill Clinton having the best return since Herbert Hoover? That brings us to the stimulus that was already in the pipeline. So as you can see, the 10-year yield is inverted on these charts. We're going to start on the left. This chart is as of Bill Clinton's inauguration, and rates had been getting cut. The 10-year yield had been falling significantly ahead of Bill Clinton entering office. And what we saw right along cue as he entered office, the ISM Manufacturing Index, which we use as a proxy for the economy, it is an LEI just like the S&P 500, headed straight up, right alongside interest rates, just as we would expect. So here's a piece of evidence for maybe presidents benefit from the monetary backdrop that they are assuming office, right? So the monetary backdrop is already baked in stone when they are making their inaugural address. They don't get to choose exactly when they're entering the presidency and what interest rates had been doing for the 12 or 18 months ahead of that date. Now, we'll give another example. We're not even going to talk about George H.W. Bush's policies, but I'll just show you a similar dynamic. When he entered the office, starting the chart on the left, there was monetary tightening in the pipeline. What we saw, economic growth, or the ISM Manufacturing Index in this case, headed lower right alongside it. So it is the backdrop, the monetary backdrop, that matters the most, at least in the first 1 to 2, maybe even 3 years of a president assuming office. There was no type of policy within the realm of normalcy, I should say. Obviously, we've seen some announcements of policy that break normalcy, that impact the stock market outside of its general trend. But any sort of normal policy, whether that's tax increases, tax decreases, increased spending, decreased spending, generally is not enough to knock the market or the economic trajectory of the US off of the path laid by interest rates. We can even zoom in a little bit on specific sectors. So, one of the big promises that Ronald Reagan made leading up to his presidency was that he was going to massively boost defense spending. He was going to invest in the US military. Here I have US military spending as a percent of GDP. When he assumed office, it was about 4.5. That went all the way up to 6%. It almost doubled the amount of military spending. So you would think defense stocks probably did well during this period. Well, if we start here with the chart on the left, markets did price in the policy change. So when we got the election results, we see that aerospace and defense companies performed well immediately following Ronald Reagan being the president or the announced president-elect. But what we saw after that was, yes, the stocks were up about 12% in the 2 months following the election, but then the business cycle took over. These stocks tend to be cyclical. And so when the ISM Manufacturing Index turned lower, we see that the aerospace and defense composite, relative to the S&P 500, started to underperform. So the overall economy still dominated this trade, even though there were very specific policies in place by Ronald Reagan that should have given a bit of a boost to this sector. And now, what about scandals? So I hinted at this earlier. What about when presidents really mess up? Certainly the leader of the economic engine of the world, whatever you want to say, the economic backbone of the world, the leader of the US economy, When they mess up, they're about to get impeached. They might get kicked out of office. Certainly, the S&P 500 should react to that type of volatile event that doesn't occur very often or used to occur much less frequently than it does now. So let's look at the two most public and popular examples. I made a joke in the long form piece that the first one was President Obama wearing a tan suit. I was thinking about taking the S&P 500 during that time period and pretending that it was serious, but I know some people are already not going to like this video, so I'll just stick to the actual facts here. So we'll start with the Nixon impeachment here on the left. And generally speaking, the market stayed on trend. There was nothing crazy about the S&P 500's movement during the impeachment process when it began and when he resigned that wasn't explained in the fall of economic growth or other LEIs like the ISM New Orders Index. So certainly the Watergate drama added to the noise, added to the uncertainty, but nothing occurred outside of the general expectations of where the economy was headed when it came to the stock market. And then we'll look at the second one, which was the Clinton impeachment trial and the whole scandal surrounding that. We had the exact opposite setup. So even if you want to say during Watergate stocks fell, on the right-hand side here, when we look at the Bill Clinton impeachment, we see a similar but opposite dynamic. Throughout the whole process, stocks continued to move higher alongside growth in the ISM New Orders Index. So the economy was a much larger impact on the stock market than either of these scandals were, right? You could look at the Watergate thing and say stock market tanked, but the economy was falling alongside it. You could even look at the Bill Clinton impeachment and say he was ultimately acquitted and didn't leave office, but the economy was rising alongside the stock market. There was nothing unusual that occurred with two of the largest public scandals, the most covered public scandals that we have had in recent memory. So, does that mean we should stop grading presidents? We should stop paying attention to the stock market when it comes to presidents? Grading potentially, but I'm going to say no, we should not stop paying attention. And the reason for that is the stock market is an excellent policing mechanism. I'm going to give you two recent examples. One here I'm going to show in the chart. Stock markets played a big role in the tariff fiasco that happened in 2025. So we showed a little bit of this earlier, the reaction of markets on Liberation Day. Well, that's what the S&P 500 did over the course of two sessions. That is the first light blue bubble here on the left. The S&P 500 fell significantly. I believe it was 11%. This pressure, this attention, this noise on these tariffs eventually led to a 90-day pause a few days later. And as you can see, the stock market shot back up, not exactly to the same height from where it fell, but it filled in a lot of that gap. I would venture to say that it was the reaction to the stock market falling that generated this pause. I would venture to say right now, probably not the only component, but a big component that's separating the tough talk of our dealings in the Iran war and a full-blown intervention is fear over stocks falling ahead of the midterm elections that are in just a few months. So yes, we should not grade presidents based on the stock market performance, at least in their first few years, barring some instances where maybe the stock market separates from the overall trend of the economy or the overall path being laid by interest rates. But that does not mean we should stop paying attention, as the stock market is an excellent policing mechanism that can stop presidents from making major mistakes. That's what I'm going to leave you here with this week's Macro Monday video. Again, apologizing for reusing content if you had already read our long form version of this. If you would like to read the long form version, that is in the description of this video. If you did enjoy this video, I would really appreciate if you could take a second to subscribe to the channel. We are seeing some decent growth here, and I would love for you to join the party. Okay, I will see you next week with another Macro Monday video. I hope you guys are enjoying the summer. Have a great week.